Welcome. My name is Ernest Joseph. I will be your host for today. Welcome to the MMC. Really appreciate you guys for taking the time to watch those videos and all the comments you got been posted. I really appreciate that. I see a lot of you been, passing that exam. Congratulations to all of you that been doing that. If you focus, you can pass the exam, but you got to stay in top of your game. So today I'm going to cover some more information. Another way I'm gonna do this, so you guys can be able to continue learning with us. So we want to make sure you become successful when it comes to this. Okay, don't forget to if it is the first time you find us, just hit the subscribe and then make sure you press the notification bell, and you know all the good stuff, and then share with somebody else that you know that gonna learn from this video. So let's get into it. Today we're gonna discuss what insurance is. Okay, because there's different way when it comes to life insurance. People need to know what insurance in general. Insurance really, we're gonna discuss that. We're gonna explain to you what is it about. Let's talk about that. Okay, so insurance transfers the risk of loss from an individual to an insurance company. What we call the insurer, which is that's another name for insurance company, is insurer or principal. It protects against financial loss due to the insured death. So what do I mean when it comes to insurance? So the reason you're buying a life insurance or any insurance out there is because you don't want to carry the risk on your shoulder, and you take it and you transfer that risk to an insurance company. So that's been the best way to avoid risk is by transferring the risk to an insurance company. So that's why people buying life insurance or health insurance, home insurance, or maybe car insurance, or maybe dental insurance, whatever that insurance is because that you don't want to carry the risk. Then that's one way to avoid the risk. Is called transfer. Okay, and later on maybe we might find another later on to do another video for you guys when we talk about there's different way you can do this. So that's the best way to avoid it, is to make sure that you can take that risk and transfer it to an insurance company. Now when the person pass away, when the insured pass away, now the risk that transfers to all the insured into that company. So it's not just only one person. Is one person pass away and then, well, it just affect that one person. Everybody's that, because everybody putting money into that insurance company, so it affect every single one of us. The money comes from all of us at the end of the day. So but remember, insurance transfer the risk from one individual to an insurance company. Okay, now what is a policy owner? It's the person who buying the policy. The person who buy the policy, we call them policy owner. They own the policy, and they're also the one that responsible to pay the premium. And also you need to know, only the policy owner can make changes, because if the policy have cash value, only the policy can request it. Now there is going to be some exception when it comes, if there's an irrevocable beneficiary, then the policy owner and the irrevocable beneficiary have to get involved. But for the purpose of this learning, is you have to know all the changes need to be done by the policy owner. So if the insured, for example, if they're not the same, and the client, let's say you have this person A, they the policy owner, and this person B is the insured, so all the changes gonna be done by A, not the B, even though the B is the insured. So if they want to change the bank account, A is responsible to do that. If they have to put the policy ups and down, A is the person, which is the policy owner. He's the one that can make all the decision about the policy. If they want to assign this policy away, the policy owner can do that, because all the rights reserved to the policy owner if they're not the same person. If they're the same person, so of course, but if they're not, the policy owner is the one that can make changes. Now we're gonna continue with that. Also, we're gonna talk something about insurance company, what we call the insurer. Okay, the insurance company, they issues policy. The reason they call them insurer is because they issues policy. They receive the premium that the policy owner pay every single month, or every 3 months, or maybe every 6 months, or every year. What we call the premium mode. So they receive that premium and they pays the benefits if the death occurs when the policy is active. So the only way the insurance company gonna pay is if the policy is active. So if the policy is not active, they're not responsible to pay the beneficiary. So you have to make sure you pay your premium in order for them to pay the death benefits. But they issues policies. That's the reason they call them insurer. They issues policies. Another name for insurer we refer as principal. Make sure you know that. Now, the beneficiary, I would tell you this, the happiest person, even though you see that person probably crying all day, you know, in that. But the policy owner is the person that that's going to receive the money. The policy owner receive, the beneficiary, excuse me, receive the benefits, the death benefits. And that's why we call it the happiest person. That doesn't mean they're happy for it, but it's just a joke, just to remember. So the beneficiary have nothing. Now, you don't need any consent to add the beneficiary, to be honest. You have to let them know, of course, at least, but you don't really have to let them know. You can if you want to, but I think it's ideal to let them know they're the beneficiary, but you don't need anything. But the policy owner, in order for you to put a policy on someone, if you're gonna put a policy on somebody else, you have to get the consent to do so. But you don't need the consent of beneficiary. Beneficiary have nothing to do with anything. You just sit there and then wait for your stuff. And the beneficiary cannot make changes unless, when we talk about the irrevocable beneficiaries, they might get involved. Okay. So the beneficiary, they receive the benefits from the insured death. They can be primary or contingent. Primary beneficiary, they the first person in line. If the client or the insured pass away, they the first one to get the money, the death benefits, or the proceed, or the coverage. Now the contingent beneficiary, that doesn't mean second, it means next in line. Because when you go to a store, they don't want to say contingent. Nobody gonna understand what that means. Contingent, what do you mean? But they're gonna say next. So now if they have a second beneficiary or a contingent, and you're gonna go to the second. Or if there's a third beneficiary, you're gonna go to the what we call tertiary beneficiary. Okay, that's another way they can also put something. Tertiary mean third in line. So that can go to the third beneficiary. So contingent just means next. So if there is no contingent and the primary passed away before the insured, the money can go to the insured states, unless when you learn about the common disaster clause or the common disaster with simultaneous death law, in case if there's a scenario where they cannot determine who died first, is it the client, the insured, or the primary beneficiary? If they cannot determine who died first, the money gonna go to the insured state, unless there's a common disaster with simultaneous death law, and that will allow the beneficiary to outlive the insured, but they have to live at least for 30 days or more in order for their state to get the money. So that's a little bit for more information for you. So just remember, the beneficiary, they the one that receive the benefit. Except I must have to tell you that when you have a whole life policy, the policy have to endow or maybe finish or terminate it, or not terminate it, but the policy will be get to a point where it's mature. As I say, it's mature at age 100. So when that policy endow at age 100, so now they will pay the death benefits now to the insured, not the beneficiary, because that's a win if they get to live to 100. But that only applies to whole life policies. So now another concept we're really gonna explain to you is what we call insurable interest. So you can't really just go ahead and out of nowhere, you just, I'm gonna put policy on people because I see that person is gonna die in the next 1 or 2 years. So therefore, I'm gonna go ahead and put a policy on them, and you can't do that. So insurable interest, it's a requirement that a person must have financial interest in the life of the applicant when purchasing a policy. So you have to make a difference between the applicant also and the policy owner or the insured. The applicant is when you apply. So you're not an insured yet, because you're gonna become an insured when they get you approved. But when you apply for it, you are an applicant. So in order for you to put a policy on someone, you're supposed to have financial interest in that person's life. So insurable interest must exist at the time of the application, not at the time of loss. So if you're going to put a policy on someone, you have to make sure that person, you have insurable interest on that person at the time you're doing it. Perfect example I always pick when it comes to this is husband and wife. Okay, let's say two people go and date, boyfriend, girlfriend, or their fiance, and they're going to get married the next day. They cannot do a policy. If they're going to the court the next day, they cannot say, oh, well, since we're going to the court the next day, why don't we do the policy today? But until they go to the court to do make sure everything is legal, they do not have insurable interest yet. So that's what that means. Or they cannot wait, or if the person passes away, then you're going to put no, there's no such thing anyway. You can't do that. So you have to exist. Insurable interest must exist at the time of the application. So you can't put an insurance on the baby that's not born. Even though, kids have insurable interest on parents and parents on kids, but if the kid is not born yet, you cannot say, oh, I'm going to cover the baby inside my stomach. Can't do that. So that's what they mean. You have to exist at the time of the application. Another example. Let's say that if you're going to go to a bank, you're going to buy $100,000 at the bank. So now the bank going to have insurance on you because you have $100,000 in your hand. Because if you die, you're going to affect the money, that $100,000. So the bank can put a policy on you. But until they give you that loan, they can't do that because you have to exist at the time of the application, not the time of loss. Now, it also means it's the possibility, it must exist that the policy owner may lose something of value, money, if the insured die, such as income. Because now, if the income, if they're gonna lose like the income, the possibility of losing that income, so you put an insurance on that. Because if the income no longer coming in, it's gonna affect you. Of course, you can put the policy. That's why you can see when you come to a key employee, and the employer can put in policy on the key employee, but not the employee. The key employee cannot put an insurance on the employer because the key employee, because now you're gonna affect my income, because if you pass away, of course you're gonna affect my income. I can put insurance on me because if I pass away, you're gonna affect my income. So I'm not gonna no longer be there to provide income for my family. So I can put insurance on my income as well, on myself. So maybe like something of value, like a home, like money. So once you're gonna affect something like this, you can really, that's mean insurable interest exists. So therefore, you can put an insurance on that person, either yourself or to a husband and wife, because that's who have insurable interest, or maybe a lender can put a insurance onto a debtor, or what we call a borrower. Okay. Also, business partners, they can do, because if they're going business together, they put, let's say this business partner put 50,000, this one put another 50,000, so they can put insurance on each other because they have. But until that business comes together, they can't do it. But once they put that business together, everything become legal. So now they become business partners. They can put insurance on each other. Okay. Now, there's something I want to mention right quick. There is one exception to the rule. It's what we call a stole policy. We're going to cover that into another videos. Watch for that when that's coming. But a stole policy, what we call a stranger originated policy, is violate the concept of insurable interest. So that's the only way. It's pretty much like, it's an investors. If somebody have a policy, now they're selling it. Now that person can buy that policy because I'm an investor. I'm going to go buy that policy, but I don't need to have insurance on the person who's selling it. So now because of that, this become a stranger originated policy. Now that's called a stole policy. So it's violate. You have no respect for the insurable interest. So it's violate that concept. So make sure you do understand that. So really appreciate you guys for taking the time to learn this. So pay attention. I'll see you on the next video.